What is up, traders? What's up, tycoons? Super excited for today's video. Lots to discuss. Now, let's take a look at some of these recent headlines. Citi is planning to job cuts, right? Goldman making annual cut. Wells Fargo expects more layoffs ahead. The Fed is on alert for one more rate hike after disappointing inflation. And Jamie Dimon says it's a huge mistake to think that the economy will boom with so many risks out there, right? He's warning investors over bank stocks and he slams regulators on capital plans. We're going to break down all of this in today's video and go over some of these warning signs and some of the risks that people like Jamie Dimon are speaking of. So be sure to smash the like button, subscribe to the channel if you guys are new. All right, as always, the content provided on this channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So please be sure to read through the full disclaimer and we'll jump straight into it. Now, the bears are going to tell you this is exactly where we are right now in the cycle, okay? They're going to tell you we're right here at this return to normal. This is a market psychology chart and sheet, basically, and you can see that it does seem to align with this. After we get the bull trap and we're at this return to normal phase, it's very possible that the market could be due for this next leg down. This is what the bears are screaming right now, okay? And this is what all of the bears are telling you. So we need to dive into, what's the reason, what's the thesis behind this? Well, of course, when you take a look at the yield curve, and this is the 10-year 3-month, right? The last time it was inverted, 1990 recession, then we have the dot-com, then we have the great financial crisis, we have the 2020 recession, that was largely due to COVID. And look at where we're at now, okay? This is very, very significant. And this is something that everyone is warning about. Now, just to visualize it another way, okay, we have the 10-year, 2-year yield curve right here, and then we have the Fed fund rate, and then we have the SPX, okay? So what we're looking at here is you really start to see a bunch of pain in the market once the yield curve uninverts. That's typically when the Fed starts cutting rates, right? That's a result of the Fed cutting rates. And so with the Fed cut rates here, in 2000, the yield curve uninverted went up, and look at the performance of the stock market afterwards. Same thing over here. Fed starts to cut rates, yield curve uninverts, and the stock market goes down. And here we are right here, very far away from a yield curve inversion. But, if the Fed does end up cutting rates, it's going to be because there's problems and big problems and something is broken, right? That's typically when they start to cut the rates. And that's typically when you start to see the yield curve uninvert. And that's typically when you start to see the large drawdown in the market. All right, you don't always see it when the yield curve is uninverted. If you see here, the yield curve's uninverted, the yield curve is inverted, and the stock market's continuing to go up. All right. So, it's not always the case that you have to have a mega crash when the yield curve is inverted. It's more so once it's uninverted and once the Fed starts to cut rates, you can see that that's typically when the yield curve starts to uninvert. Now, the business optimism index is, at current levels that have all seen recessions, right? The gray shaded areas here are recessions, and you can see where we're at right now has all been preceded by a recession. I do want to mention that I started a completely free newsletter for you guys real quick, giving out free valuable content, as well as a couple free trade ideas in there. This is a recent example of a Tesla trade that was in the, newsletter a couple of weeks ago. And if you take a look, after some of the conditions that we went over, Tesla rallied tremendously. And if you trade option contracts, those were some very juicy returns. So if you want to sign up for the newsletter, there's a link in the description or the comment section down below. Great way to support the channel and also support me. You can also go to Ko-Fi. All right, Ko-Fi is a really cool platform. You can go in there and click commissions, and you can request a specific YouTube video in there. You can also book one-on-one personal sessions directly through there on the commissions side. All right, there's 30-minute sessions, 1-hour sessions. And if you ever enjoy the content and want to leave a tip or a donation, you can, do that through the platform as well, clicking the buy a coffee button, basically. Now, let's get back into the juice of the video. Now, these are sequences of 7 negative NFP reports. These are the non-farm payrolls, 1985, 2008, and now we're at 2023. This is 7 consecutive ones, right? And these are negative report revisions. Look, all right, we all know what happened in 2008, okay? Great financial crisis. Look at the other time when there were sequences of exactly 6 negative NFP reports in 2016 and in 2002. Right. So, this is, more things to be cautious of and more risks, as Jamie Dimon puts it, to the economy and to the market. Now, another thing that's really been surprising, okay, and what I mean by that is when you take a look at the Fed's total assets, okay, it's been on a decline, right? You can see that there's this big boost here in March, all right, that was due to the banking crisis and them stimulating the economy with tons of money. And now we're seeing it trickle off more and more. The Fed has been doing quantitative tightening, right? And so they're actually taking money off of the balance sheet rather than adding to it. And we're seeing a divergence right now, okay? Because oftentimes stock market performance has been very closely correlated with the Fed balance sheet, right? And so that's what this greenish, tealish line right here represents. And the blue line represents the S&P 500. So, you can see the S&P 500, tends to rally along with the Fed balance sheet. Fed balance sheet starts to pull back, stock market starts to pull back, right? Fed balance sheet goes up, stock market goes up, and we are at this current divergence right now. Now, people are calling this the Magnificent Seven effect. Basically, the top seven stocks in the market are pushing the entire market up higher, even though the Fed is draining liquidity and, not adding to their balance sheet. But these two they really don't tend to stay separated and diverged like this for long. So one of these is going to have to change, right? We're either going to see the Fed start pumping money into the economy, or it's very possible that the S&P 500 is going to pull back and get rid of this deviation between these two lines right here. All right. And another thing, if you want to take a look at, M2 is at levels, I mean, it's negative right now. All right. The M2 money supply is negative. You look at mortgage demands, it hits 1996 lows, right? We haven't seen this. It's the lowest level since December of 1996. The quarterly transition rates for 30, 60-day late mortgage accounts, you can take a look at this chart right here. Things are just not looking good in the housing market, right? And in the real estate market. When you look at the collapse in home buyer demand, this is mortgage applications to buy a house. It's at the lowest buyer demand in 20 years. That's where we're at right now. And when you look at the debt to income ratio for all home buyers, we're at levels higher than the 2006 2007 housing bubble. Okay, so this is something that a lot of people are concerned about. These are some of the risks. Now, of course, with inflation, okay, and with people technically making more money, I mean, you should kind of see debt rise, right? It's healthy to see debt rise, but it's still shocking, and we're still at very concerning numbers, especially when you look at it, compared to where we were at in the 06 07 housing bubble and where we're at right now. Now, commercial bank interest rate on credit card plans skyrocketing, right? We're seeing commercial bank interest rates for credit cards extremely high right now, and that's largely due to the Fed. When you look at the loans and leases and bank credit, this is tanking, okay? So this is tanking. So the loans and leases and bank credit for all commercial banks is tanking, right? And then you have the actual, interest rate on your credit cards skyrocketing. All right. And then what we're seeing here is the personal savings rate in green absolutely tanking, right? Collapsing here. Right now, it looks terrible because of this right here. This is COVID. Okay. So everybody had this really large personal savings rate, and it looks more dramatic than it is. But what you really want to see is the pre-pandemic levels, right? We are far below the pre-pandemic lows for the personal savings rate. And the red line here is revolving credit card debt and the debt change, and you can see this skyrocketing. Okay, so this shot down tremendously as the personal savings rate went up, and now that we've seen the personal savings rate tank, we're seeing revolving credit debt change absolutely skyrocket here. And we just took a look at how high the interest rates are on new credit cards. This is the quarterly change in deposits. You can see that this has been going down for ever since 2022 bear market really started. This has not been, looking good. All right. At the average monthly payment for a new car in the US is up to $733. Okay. I remember when I started paying my wife's Toyota Corolla bill, okay, and started paying that for her before we got married. And I was like, man, you're paying $560 for a Toyota Corolla. And now, I mean, that's like not even insane anymore, right? Thankfully, we're basically about to just pay that car off. But if you're out here looking to get a new car, it's extremely high, right? And if you want something nice, okay, quote unquote nice, it's probably going to be upwards close to $1,000 a month, right? And this is a monthly payment just for a vehicle. Now, the transition into delinquency by loan type, you can see student loans fell off a cliff here. Obviously, this is about to change and potentially change because student loan payments are going to start again very soon. All right. But when you take a look at the mortgage is going to be in this gold color. Okay. Credit card and auto loans all in an uptrend, right? In a significant uptrend ever since bottoming out in 2022. Those have all basically been in an uptrend, and with the transition into delinquency. You look at third-party collections, the average collection amount per person with collections is going to be this red line here. You can see this is north of $1,500 now, and the percent of consumers with collection has dropped lower, but the average collection amount is really what you're seeing right here is going up by a tremendous amount. Now, what does all this tell you, right? We're looking at all the financials. We just took basically a bunch of numbers, had a bunch of different financial aspects of the economy. What's the stock market got to say about all of this, right? And when you actually look at the financial sector in the stock market, it's telling you it's not worried, right? It's literally telling you it's not worried about it. So, maybe the market sees something that we don't, and maybe the market is pricing in this soft landing, right? That's been a big narrative. And that's one of the risks that Jamie Dimon is basically warning people of is, hey, clearly the stock market is not concerned, right? Financials have bottomed since March and have started a very strong rally. And it looks like, via Elliott wave after this breakout, it looks like we put in our wave 4 lows and we could be heading up on the XLF ETF back up to $36. Right. I mean, we've seen a clear breakout here on the financial sector. We're seeing the same thing in JP Morgan. So ticker symbol JPM also breaking a recent downtrend. We got a clean breakout retest. Let's see if this thing is going to push higher. Right. The stock market does not seem to be concerned about some of these risks. Okay. And that's something that you need to understand, right? The economy and the stock market aren't always going to move in the same exact direction. Oftentimes people say the market is forward looking by about a year. So really, if you think about it, the stock market seems to believe that, all of these concerns, all of these risks, while they are something to pay attention to, they have more optimism, right? And it seems like we're seeing more optimism in the stock market, via the financial sector, right? I mean, after all those financial numbers that we looked at, M2 money supply, different things like that, credit card interest rates, things about the consumer, right? And speaking of the consumer, look at the consumer discretionary sector, right? I mean, who is telling the consumer discretionary sector that we're possibly about to have a recession, that we have all of these warning signs, right? I mean, we're not seeing that. We're seeing, tremendous rallies in the consumer discretionary sector. Again, consumer discretionary is also breaking out. So if people are supposed to be so worried basically about the consumer credit, consumer debt, all right, and basically that we're going to have a recession and that the consumer is going to be hurt. We're not seeing all of these warning signs in the performance of the stock market in the financial sector. We're not seeing it in the consumer discretionary sector. And this is what makes investing and trading so difficult, right? Is you can find all of this data, you can think that it's giving you an edge, and somehow the market sees something else and is doing something different from your narrative. So the best thing to do is, while it is important to focus on the economy, focus on the risks involved with trading and investing, you want to pay attention to the chart in front of you at the end of the day, right? And whatever ticker symbol it is, whatever you're trading, whatever you're investing in, you want to look at how that's performing, and pay attention to that, right? And use that as a signal for potential entries and exits. All right. And, you can pay attention to the economy and, some of the warning signs and the risks out there. But, you don't want to always let that skew your investment thesis. And as I mentioned before, we're seeing right now that consumer discretionaries, financials are performing very well. It doesn't seem like the stock market is very concerned about the consumer or concerned about this big recession that we're supposed to be having in the future. Now, could this all be a bear trap, right? The quote unquote return to normal, right? If you remember that very first chart that we looked at, in the video, it showed you guys how this could all potentially be a bull trap. And this is that quote unquote return to normal. And then we get a big, massive crash afterwards, right? So, that's the whole bear thesis. The stock market doesn't seem to believe the bear thesis. They seem to believe that we're going to have this soft landing. And until that narrative changes, it's very possible that the stock market continues to go higher. Now, again, I just want to mention, if you enjoyed this video, you're really going to enjoy the newsletter. Okay. Not only do you get trade ideas and trade breakdowns like this, all right, that sometimes can result in, big earnings like this, depending on if you trade options. There's also going to be valuable content in there and just general investment intelligence, hence the name Investment Intelligence for the newsletter. Great way to support the channel and also get some free content that's valuable delivered straight to your inbox every single week. All right. And also head on over to Ko-Fi using the link in the description. All right, you can head on to the commission side. You guys can request a specific YouTube video. If there's something that people aren't making that you really want a video on, or maybe there's a specific stock you'd like me to do some analysis on, you can always do that and request that through Ko-Fi. You can also book a coaching session if you ever want to do a one-on-one personal session. We can work on getting that scheduled together. And as I mentioned before, if you enjoy this content and you enjoy this video and you want to, leave a tip or a donation or something, you can also do that through the Ko-Fi platform here directly. Appreciate y'all watching the video and making it this far. Smash the like button and subscribe.